Welcome to today's Explainer. Look, if you were glued to your trading terminal today, you already know it was absolutely not for the faint of heart. A brutal May 11th market session left just an absolute sea of red in its wake. But hey, as your guide through these highly volatile waters, my goal today is to help you step back from the panic, look at the cold, hard data, and really understand exactly what drove our markets into this tailspin. We aren't just going to look at what happened. We're going to uncover the fundamental triggers and the technical breakdowns so you are fully prepared for tomorrow's bell. We've got a lot of ground to cover today, from geopolitical shocks to some absolutely critical open interest data. So let's just dive right in. Down 360.3 points. That is where the Nifty 50 ended the day. It's a massive number, right? It really demands our attention. For retail traders and seasoned investors alike, watching the index bleed nearly 1.5% in a single trading session is a stark, harsh reminder of exactly how quickly market sentiment can turn on a dime. But, a single number at the closing bell never tells the whole story. To truly grasp the psychology behind today's price action, we need to look at how this 360-point collapse actually unfolded minute by minute. Now, looking at the intraday action, it was just a pure emotional roller coaster out there. We opened with a massive gap down of 206 points, dropping straight to 23,970. I mean, that was pure shock value right at the open. But then we got the midday fakeout. From the late morning until about 2 p.m., the index actually staged this steady, somewhat hopeful recovery, inching its way back toward the 24,000 mark. But guys, it was a classic bull trap. The moment we hit that resistance zone, intense selling pressure returned with an absolute vengeance. In that final hour of trading, the bottom just completely fell out, dragging the index all the way down to a weak, highly nervous close of 23,815. So the really crucial question we need to ask is, what exactly triggered all this widespread fear? Well, to answer that, we have to isolate the fundamental triggers that drove today's very specific sectoral shifts. Frankly, we faced a perfect storm of global and domestic catalysts. Globally, the U.S. Iran peace talks have hit a complete stalemate, and that is seriously elevating geopolitical tensions in the Middle East. Domestically, Prime Minister Modi made a direct appeal to citizens today, urging restraint on fuel consumption, foreign travel, and very specifically, avoiding gold purchases for weddings for a year. The goal there is to conserve our foreign exchange reserves. Now, from a strictly market analysis perspective, these fundamental policy statements and global events sparked immediate, dramatic market reactions. The geopolitical stalemate caused crude oil to absolutely spike. The Prime Minister's appeal? It triggered an immediate crash in jewelry stocks, while simultaneously sparking a massive surge in electric vehicle, or EV, equities, as the market's focus violently shifted over to clean energy. Let's break down the most severe of these reactions. The undeniable heavyweight story of the day is the massive surge in crude oil. Crude reversed incredibly hard from its previous drops, surging over 3.2% to cross the $102 a barrel mark. Now, you might be wondering, why does this matter so much for our domestic markets? Well, India imports the vast majority of its crude oil. When oil prices spike like this because of Middle East tensions, it places an immediate, immense squeeze on India's import bill. It essentially acts like a heavy tax on the entire economy, jacking up costs for logistics, for manufacturing, and ultimately for everyday consumers. And this sudden, intense pressure on our import bill has a direct, devastating domino effect on our currency. Which brings us to a deeply alarming figure, 95.31. Today, the Indian rupee posted its biggest single-day fall in over a month, closing at a record low of 95.31 against the US dollar. You guys, this isn't just some number flashing on a screen, it's a direct reflection of deep institutional anxiety. Surging crude oil prices paired with the US-Iran stalemate have intensely magnified concerns over India's inflation trajectory and our widening current account deficit. A weaker rupee directly means imported inflation, and that gives the Reserve Bank of India far, far less room to maneuver when it comes to interest rates. This heavy macroeconomic anxiety is exactly what caused investors to just hit the sell button across almost the entire market today. And that anxiety triggered an absolutely dismal market breath. We saw only 117 advancing stocks against a massive 383 declines. High beta, cyclical sectors took the absolute hardest hits. Realty cracked by over 3%, and PSU banks dropped by a painful 2.5%. You see, when fear grips the market like this, these cyclical sectors are always the first to be liquidated. However, right in the middle of this panic, Nifty Pharma and FMCG somehow managed to stay marginally green. It makes sense, right? In a highly volatile session, capital always runs and hides in defensive safe havens, medicines, and daily essentials. Now, drilling down into the specific stock pain points within the Nifty 500, the impact of those fundamental triggers we discussed is just undeniable.
Kalyan Jewelers dropped over 9%. Other major players like Titan and Cinco Gold, they also plummeted by up to 10% today. This was a direct, immediate reaction to the Prime Minister's appeal to restrain from buying gold. But on the flip side, looking at the broader market, we saw EV makers. Companies like Ather Energy, JBM Auto, and Ola Electric, they actually surged. They were boosted by that very same speech advocating for a rapid transition to clean energy. It is a textbook example of how macroeconomic policy statements act as immediate catalysts, literally creating massive winners and losers in a single trading session.
All right, moving on from those fundamental triggers, let's talk technical realities. The open interest, or OI data, is essentially mapping out our battlefield for tomorrow. Now, what's really interesting here is the heavy buildup in call OI today. It strongly indicates aggressive resistance in a falling market. The bears were out there actively writing calls, essentially building a massive concrete ceiling right above the Nifty. With so much institutional capital betting against any immediate recovery, we have to ask ourselves, where exactly are the firm lines drawn in the sand for tomorrow?
Well, here are your clear, actionable technical levels based strictly on that options data. The highest concentration of call open interest is sitting right at the 24,000 to 24,100 zone. What does this mean for you? It means any recovery attempt tomorrow is going to hit a massive brick wall of sellers right in this area. It's a very heavy resistance zone. Conversely, the maximum put open interest provides our support base, and that is anchored right between 23,600 and 23,700. If the selling pressure continues, this is the floor where we really expect buyers to start stepping in. As a trader, you absolutely must respect these boundaries. Mark my words, if we break below 23,600 with heavy volume, the technical damage is going to be severe.
But hey, it's absolutely essential to remember that even on a broadly bloody day like today, strong fundamentals eventually shine through. Here are a few silver linings from today's corporate earnings. Tata Consumer Products surged over 8% after reporting a fantastic 21% jump in net profit, along with some really strong margin expansion prospects. Sasken Technologies, a massive outlier today, surging 20% after its profit jumped an incredible 145% year-over-year. Even in the badly beaten down banking sector, Canara Bank showed a steady 4% rise in net interest income, despite the overall profit pressures. This brilliantly highlights that stock-specific opportunities based on robust earnings are always going to exist, completely regardless of the broader macroeconomic noise out there. Which really brings me to a crucial mindset shift we all need to make on volatile days like today. Dr. Anish Shah, the group CEO of Mahindra & Mahindra, noted today that their overarching theme is going to be accelerate in uncertainty. I absolutely love that. He recognizes that uncertainty isn't just going away, but a strong foundation leaves you perfectly poised to actually take advantage of it. My friends, this is the exact mindset of a winner. Volatility and uncertainty, they are permanent features of the market. They are not bugs. If you have a solid foundation, if you really understand your support levels, the macro triggers, and those solid corporate earnings, you don't panic during a 360-point drop. No way. You use it to aggressively capitalize on the fear of others. So I'm going to leave you with this final thought. We have mapped out the macroeconomic catalysts today, from those crude spikes right down to a record low rupee. We have drawn our technical lines in the sand, with massive resistance at 24,000 and critical support at 23,600 based on the open interest data. The battlefield is completely clear. The question is, based on everything we've covered in this explainer today, how are you positioning your portfolio to accelerate in this uncertainty? Are you going to hide, or are you going to identify that fundamental strength amidst all the panic? Review those charts, respect your risk limits, and stay fiercely focused tomorrow. Thank you so much for joining me for this analysis.